Your credit score decides what you pay for almost everything financed in your life. Your mortgage rate, your car loan, sometimes even your apartment application and your insurance premium. And yet most people have no idea how it's actually calculated. Today, in about 5 minutes, the 5 factors that make up your score, how much each one really counts, and the moves that raise it fastest. First, the basics. Your credit score, the FICO score most lenders use, runs from 300 to 850. Above 740 is generally considered very good, and above 800 is exceptional. The difference isn't bragging rights. On a big loan like a mortgage, the gap between a fair score and an excellent one can mean paying tens of thousands of dollars more in interest over the life of the loan. Same house, same income, different score, very different price. So what actually builds that number? 5 factors, and they are not weighted equally. Factor 1, the biggest, payment history, about 35% of your score. This is simply whether you pay your bills on time. Every on-time payment quietly builds your score. A single payment reported 30 days late can knock a good score down significantly, and late payments can stay on your report for up to 7 years. If you do only one thing after this video, set every account to auto-pay at least the minimum. That alone protects over a third of your score. Factor 2, amounts owed, about 30%. This is mostly your credit utilization, the percentage of your available credit you're using. If you've got a $10,000 limit and a $3,000 balance, you're at 30% utilization. Lower reads as safer. Under 30% is decent. Under 10% is where the top scores live. And here's the part most people miss. Utilization is usually measured when your statement closes, not when your payment is due. So you can pay in full every month and still look maxed out. The fix, pay your balance down before the statement closing date, or make a mid-cycle payment. Factor 3, length of credit history, about 15%. How long your accounts have been open on average. This is why closing your oldest credit card is usually a mistake, even if you never use it. That old card is your credit history. Keep it open, put a small recurring charge on it, and let it age like a good bottle of wine. Factor 4, new credit, about 10%. Every time you apply for credit, a hard inquiry lands on your report and shaves a few points off temporarily. 1 or 2 are no big deal. A burst of applications in a short window reads as risk. Space out applications when you can. And know that checking your own score is a soft inquiry and never hurts you. Factor 5, credit mix, the last 10%. Lenders like to see you can handle different types of credit, a credit card plus a car loan or student loan, for example. It's the smallest factor, and it's not worth taking on debt just to diversify. Let this one happen naturally. Add it up, and the picture is simple. Pay on time, keep balances low, keep old accounts open, don't apply for everything at once. That's 90% of the game. There's no secret hack. The boring habits, repeated for years, are the entire strategy. One myth worth killing before we go. Checking your own credit does not hurt your score. That's the most persistent piece of credit folklore out there. You can and should check your reports for free at annualcreditreport.com from all 3 bureaus. Look for accounts you don't recognize and payments wrongly marked late. Errors happen more often than you'd think. And disputing them is free. Quick disclaimer, I'm not a financial advisor, and this video is for educational purposes only. Exact scoring formulas are proprietary, and the percentages here are FICO's published approximate weightings. Your specific score may respond differently based on your overall profile. If this finally made your credit score make sense, subscribe to Control Your Wealth. New personal finance breakdowns every week. And drop a comment. Which of the 5 factors surprised you most?